chain, meaning that it's mostly supported and run by venture capitalists. There's Solana, there's AVAX, there's Phantom, and Luna. Luna, in this case, owned something like 56% of the token supply before we left PEG was owned by VCs and founders, so it was not very decentralized, which kind of was the seed of very, very bad problems going forward. So yeah, that being said, for those of you not too familiar, history was made last week, not in a particularly good way. Luna, one of the biggest blockchains on the planet, I think it was like top 15, top 20, went from top 20 to 0. Literally, you cannot buy or sell Luna tokens. If you had bought them at any point before last week, you would have literally made a complete loss. We've had situations before where cryptocurrencies have lost like 90+% of their value, but we've actually never had a situation where the value of the token's fallen so hard that you literally can't sell it. So this has been a very unique situation in the history of our industry, and I kind of want to take some time to unpack it and explain it all. If you have any questions at any point, I'm going to throw jargon around that I'm not going to realize that is jargon, so stop me. That being said, going back to kind of some background information, the last 2 years of the cryptocurrency industry have kind of been ruled by smart contract platforms. So that's Ethereum, that's Luna. They're no longer just blockchains, they're more like decentralized computers where you can store and execute code on the blockchain. I'm sure we're all somewhat familiar with that. And this has become very lucrative because when you're able to run and execute code on DeFi, it kind of opens up a world of possibilities, things to do with these blockchains. Decentralized finance is kind of the first iteration of things to do. It's evolved into NFTs, DAOs, etc. And there's a whole lot of people that want to become the king of smart contracts. Right now it's Ethereum, they're kind of the industry leader, but we've seen the rise over the past year of other chains like Solana, like AVAX, and like Luna. And these chains have become very popular. Luna in particular, between its two primary tokens, Luna and UST, had a market cap of $68 billion. And due to the fact that it was fundamentally broken, it went from a $68 billion market cap to an effectively $0 market cap, which is incredibly tragic. I'm not even joking. You know, when things like that happen, you know, people act irrationally. You don't have to imagine too much to understand what has happened since then. And at the center of it all, there's this guy named Do Kwon. He's the guy who effectively founded Luna, the blockchain, and came up with the idea of UST, the stablecoin. He's kind of the figurehead of Luna, effectively their version of Vitalik Buterin or Satoshi Nakamoto. But his role is very much different. For one, he has a lot more sway over the Luna blockchain, thanks to the fact that he simply owns a much larger stake in the entire network compared to the other two people. Additionally, he's kind of developed a bit of a cult of personality leading up to this disaster. The Luna investor cult, if you will, became very toxic. Anyone who would criticize the blockchain or the stablecoin would be harassed on Twitter. They just wouldn't listen to people, and that ultimately came to bite them very hard in the ass. So yeah, let's see. Let's break down what money is, right? Because we're all engineers here. Some of us are business people, but I think it's worth reviewing what money is, because it's important. It's cryptocurrency, right? So money has three primary characteristics, right? Number one is it's a store of value. Number two is that it's a medium of exchange. Number three, it's a unit of account, right? In order for your money to be widely adopted as money, it needs to fulfill these three criteria, right? And this is where traditional cryptocurrency fails. When you look at things like Bitcoin and Ethereum, they're very volatile assets. They behave more like securities, right? As a store of value, they're not super great because the price can be $3,000 one day, it can be $2,000 the next, it can be back up to $3,500 the day after that. It can be difficult to actually have savings in ETH. Second one is that it's a medium of exchange. And we've actually seen Ethereum improve in this aspect as of recently, especially when you look at just purely on the Ethereum blockchain and on other blockchains. For example, NFTs on OpenSea are pretty much exclusively measured in terms of Ethereum rather than US dollars, meaning that no matter what the price of ETH is, if I have an NFT worth half an Ether, it's always going to be worth half an Ether, more or less. Final one is a unit of account, and this is where cryptocurrency, as we know it, has completely failed, and it likely won't ever succeed at this in its current state until the market cap reaches the trillions. And that's obviously because, again, it's volatile in nature. Imagine paying for your coffee in Apple stock or in Google stock, right? It's not really easy to do. Obviously, the infrastructure is not there. But figuring out the price of that asset at any given moment is also difficult. And those issues are multiplied by an order of magnitude because it's crypto. It's fundamentally very volatile. That's where stablecoins come in. Stablecoins are cryptocurrencies built using smart contracts that have some kind of stable value. For most of them, pretty much all the major stablecoins, they're measured in terms of US dollars. So we've got DAI, we've got USDC, and we have Terra, or USD. USD, right? All of these coins have different ways of maintaining their value to the US dollar. Obviously, these are assets that are subject to supply and demand like anything. So they have to employ special measures to make sure that the market price stays roughly at $1, give or take a cent at most. At the end of the day, of course, all money is based on faith. The ability for these stable coins to remain stable relies solely on people's faith in the mechanisms used to stabilize them. Now, what are these? So DAI is what we call an over-collateralized stablecoin. So when you own a DAI, there is over $1 worth of Ethereum locked up, removed from circulation, right? And what that means is that when the price of DAI fluctuates, it opens up what we call arbitrage, meaning that, let's say DAI is worth 97 cents, for example, right? You can go on an exchange where DAI is worth 97 cents, buy it at 97 cents, and then you can go to the creators of the DAI stablecoin, and you can burn the stablecoin and receive that locked up Ethereum, $1 worth of Ethereum, essentially. And because of that arbitrage, it can happen in both directions. The price of DAI remains relatively stable. For an example of the other type of arbitrage, say DAI is worth $1.05, right? What you would do is you would take your Ethereum, your volatile asset, you would lock more than $1 of it away, and you could take out a loan of DAI. And these tokens, it's an ERC-20, it can get created out of thin air because it's got this debt backing it. The advantage of this is that it's very stable and very decentralized, meaning that anyone on the planet can go to the creators of DAI. It's a DAO called MakerDAO. Anyone can go to MakerDAO and do this arbitrage and create or destroy DAI. It doesn't matter who you are. You could be here, you could be in Germany, you could be in North Korea. If you had an internet connection, you could do it. The downside is that it's very capital inefficient, as we call it. For every one DAI, every dollar's worth of DAI out there, there's always going to be more than $1's worth of Ethereum out there. Usually it's about $1.50 in order to back DAI. And that's a problem because it becomes a huge money sink. when you get into like the billions of DAI, right? There's something, how much DAI is in circulation? It's like over 20 billion now. You can take a check, or you can use my computer if you want. But yeah, it's in the billions, and that means there's many more billions in ETH.
So, I guess one question that I have is, as far as I can tell, the reason why it's going to be like stable relative to the US dollar is because you have that like dollar amount in ETH, right? But I guess my question is, what if the value of ETH were to change then? Because that amount of ETH that was locked up suddenly might be worth less than $1, right?
Absolutely, great question. So a couple weeks ago, I talked about DeFi money markets like Aave or Compound, and how they work is you essentially deposit collateral, and you're able to take out a loan up to a certain percentage, called a collateralization ratio. And that's essentially what Maker is doing here. They're creating a money market, but instead of having both assets essentially in reserve that you can just grab and take out, when you deposit your ETH as collateral, you're taking out a DAI loan, and that DAI is being created out of thin air. And when the value of your collateral goes down, you actually get liquidated, which means that you get to keep this DAI, whatever you ended up doing with it, it's good. But all that ETH you had, whenever it fell below that collateralization ratio, let's say your ratio fell to, the current collateralization ratio is like 150%, right? Say it fell to 110%, right? What would happen is the dollar's worth of DAI, or however much you borrowed, you get to keep. This ETH is sold on the open market, and because it happens on the blockchain, it happens instantly, so there's very little risk of MakerDAO being short on money. It's as soon as this ratio falls below a certain amount, it's still going to be over collateralized. It'll just sell it on the open market, it'll pocket the difference, and
Okay.
that'll make sure that there's always, like, DAI is always backed by something.
Okay.
Right, so we have DAI. The other major stablecoin I want to talk about is USDC. And USDC is what we call a centralized stablecoin or a custodial stablecoin. What they do is there's a bank, right? I'm going to draw a really bad bank here. Right? This bank's called Circle. And Circle has a vault, right? That has, let's say, $20 billion in it. I like 20 billion. It's a good number. I think it's roughly what it's at, right? What's the market cap of USDC?
52.3 billion.
Okay, 52.3 billion. So there is $52.3 billion in Circle's little vault here, right? And what they do is that for every dollar that they have in this vault, they'll create one USDC, which is, what's the thing for it? It's just like a dollar sign. Yeah.
It's on the screen.
Awesome. And the advantage to this is that it's a little more capital efficient than DAI, right? Whereas for DAI, you needed more than $1 worth of collateral to mint one. For USDC, only $1 needs to be locked up, and it's fiat money, meaning that it doesn't really affect liquidity on chain for Ethereum. The disadvantage, there's two primary disadvantages. Number one is that it's very centralized. Circle, the bank, is based in the US, and they're subject to US laws and regulation, meaning that the SEC, if they at any point decide that this stablecoin setup is a bad idea, they can basically freeze Circle's assets, and then all of a sudden that, what is it? 52 billion coins, 52 billion worth of USDC is no longer backed by actual money in a vault. The other thing, of course, is the principle of faith. People are willing to trade USDC at $1 because they think that Circle actually has this money in their vault. And while they have been audited, you and I can't actually go to this vault and see those $52 billion. So yeah, that's USDC. Now, let's get to the big hairy monster here, which is UST. UST has a very interesting system of maintaining its peg. It's what we call an algo stable. So it's just ALGO stable. It's an algo stable, meaning that instead of having collateral, instead of having some asset backing the stablecoin, it has an algorithm, some kind of mechanism that automatically maintains the price of the asset with some clever tokenomics. Clever's up for debate. Essentially how it works is it's a similar arbitrage mechanism to DAI, but instead of actually locking up its collateral, it'll destroy its collateral. So the way USD, this is supposed to be UST. The way UST works, I'm just going to have a U, is that when you want to create one UST, you have to buy Luna, right? You have to buy Luna from the market and destroy it. You burn it, right? And for every dollar's worth of Luna that you destroy, you will get one UST. And when I say burn $1 worth of Luna, that's $1 worth of Luna at whatever price Luna is. So if Luna is worth $1, you burn 1 Luna, you get 1 UST. If Luna is worth $10, you burn 1 Luna, you get 10 UST. If Luna is worth 0.0001 cent, then you need to burn a fuck ton of Luna to actually get 1 UST. And the big problem with this is that it's very prone to feedback loops, meaning that in times of, like in a bull market, the demand for UST is rising, and that pumps the demand for Luna because more people want to get their hands on UST, and the only way to get more UST is to buy and destroy Luna. However, in times of low faith in the market, when people want to exit UST, they will burn UST in mass and create a ton of Luna. I'm talking trillions of Luna. They have to sell it on the open market, and that's what we call a death spiral, and that's what happened last week. People lost faith in the algorithm that keeps UST stable. They collectively burned all their UST, everyone who had investments, most people who had investments, and they took that trillions and trillions of Luna, sold it, which depressed the price further, which made people want to sell it even more, which depressed the price further. There's a little more to it than that, but I'll explore that in a moment. All you need to know is that this algorithm is kind of like, you know that not experiment, but you know that visual thing like Bill Nye did where he had like a polycarbonate box full of wound up mousetraps, dropped a ping pong ball into it, and it made all the mousetraps start to... You guys haven't seen that?
I have not, but I get an idea.
Example.
Yeah, no, well, it's, think of it kind of like a runaway nuclear meltdown, right? Basically, one participant in the market will exit their position, which depresses the price, which causes 2 other people to exit, which causes 4 people, and 16 people, etc., etc. We can actually see it in action when we pull up the UST token supply. So if we look this up here, actually Luna token supply, that's my bad.
So we're expecting the Luna token supply to shoot way up, right? Because everyone was burning USD.
Exactly. So prior to the meltdown, the supply of Luna tokens, this is the price. See if I can find the circulating supply. There's a good chart floating around somewhere. Was it?
On the right side, bottom right.
Yeah. Yeah, no, that's actually not right. Let me find this.
I think they might have that at Coin Market Cap now.
Yeah, no, I'm trying to find a chart of specifically the amount of tokens in circulation, not the price. Let me see. I had this on my phone. I thought I pulled it up. This is my bad. Give me 2 seconds, guys. TerraSmartStake.io. what I'm just gonna pass around my phone if I can pull this up. I don't know why this is giving me issues.
Yeah, it was like just overlapping, so I was just like.
It's a dick move.
Am I tripping? It was literally right here.
Just put like a frowning emoji. Just to send a message. But oh well.
Did it broke? They probably shut down the site.
Just
This is driving me nuts. Okay, you know what? I can't find the chart, but basically, there was about there was I think about 100 million Luna tokens in circulation prior to the disaster, and because of this death spiral algorithm, it went from like a few million to like 6.5 trillion. And yeah, no, like within like 4 days, it increased like literally like 100,000x. Like the Weimar inflation looks like a bitch compared to this. And that's reflected obviously in the price and the market cap. So it was kind of a double whammy because so much UST was being created, plus the market cap was shrinking, and it was kind of everyone rushing for the door, and that happened. And it got so bad as to freeze the markets because no one wanted to buy Luna, right? Because it was like some people wanted to buy Luna, they actually lost everything also during this. Which I'll get into later, trying to buy the dip. It didn't work out for them. But with the way most markets work, even centralized markets like Coinbase, they're only able to measure prices with so much precision. Usually they'll measure it in half a cent. And when the price of Luna fell below half a cent, no one was able to actually bid and like try to buy Luna. So the markets basically just froze, and people were completely lost. So yeah, that's a kind of poor graph. If I can find it, I'll send it to the channel. I think I sent some pictures of it in general. Actually, while it was happening last week, they used to have a table somewhere showing off the circulating supply. So yeah, let's pull this up. Okay. So, this system of maintaining peg is a very bad idea. It's actually been tried several times before, but it's never actually been successful. Thing is, every time a stablecoin that uses an algorithm to maintain its peg instead of collateral has failed, it hasn't led to very much fanfare because their market caps are relatively small and they didn't have their roots in like a dozen different other protocols. The reason why the Luna collapse was such a momentous occasion was because it had $65 billion between UST and Luna, and it was involved in pretty much the entirety of the Luna blockchain, UST. It was also involved in other blockchains as well via bridges. So people had UST on Cosmos and on Ethereum and on Polygon, right? And when it failed, it basically took down not just themselves and their blockchain, but other blockchains with it. Like the entire Cosmos ecosystem kind of collapsed after UST went off peg. Did I mention what a peg is, by the way? It's like a buzzwordy term. Peg is just a term we use to say when something maintains a certain value. So DAI maintains peg means DAI maintains its value of $1. UST got depegged, that means it strayed off from its $1 value significantly. You had a question?
Yeah, so what was the trigger?
So, the trigger, so remember how I said that this algorithm is inherently unstable, meaning that like one player basically just has to exit a large amount of UST into Luna to start triggering like a cascading, everyone running for the door kind of situation. That's exactly what happened. There's rumors on the internet, it's not clear. Some people claim it's Citadel, I don't think it's Citadel.
The Citadel?
Yeah, Citadel is a hedge fund, so they're like a Wall Street like firm that tries to make money trading things. But what did happen on chain is that there was some actor who basically took out a loan. They took out a loan of like 100 million UST, like a whole lot of UST. It was actually a few billion. I think it was over a billion. It was a lot of UST. And what they did was they went to an exchange built on Luna called Curve. So Curve is a decentralized exchange. Are you guys familiar with it at all? Okay, so Curve is a decentralized exchange, and how decentralized exchanges work. How decentralized exchanges work is they're like two buckets, right? Two buckets. Each of them is filled with crypto, right? So in the case of this attack, we had one bucket filled with UST, we had one bucket filled with literally anything else. It was actually technically a 4-bucket pool, but I won't get into the mechanics of that. In this case, it's just a 2-bucket pool, right? So we have DAI, and we have UST. What the attacker did was they took, a fuck ton of UST and threw it onto this bucket, and they took out all the DAI. And what happened was, because they traded so much of one asset into another, these two buckets became what we call imbalanced, meaning that there was maybe only like 900 million, 900 million UST in here, and there might have been like 1.2 million DAI, right? These aren't the right numbers, but to illustrate, it went off balance, right? There's a lot more of this asset, or actually I had that wrong, whoops. It's the other way around. There would be a lot less DAI and there would be a lot more UST. So this is 1.2, this is like 9.9. And what Curve does, and what many exchanges do when there's an imbalance like this, is that they'll automatically adjust the price internally for this pool, meaning that they'll make UST cheaper relative to DAI. And the big problem with that is that both of these are stable coins. Curve, the exchange, specializes in stable coins. They're an exchange that they trade other assets, but it's pretty much exclusively these two, or these two types of cryptos. And that makes a lot of people nervous, right, when a Curve pool gets imbalanced, because everything should trade 1-to-1. When you put 1 UST in this pool, what should happen is that you'll always get a DAI out. And this works 99% of the time. The problem is when you put enough of it and it becomes imbalanced, Curve has to adjust the price. And when UST gets cheaper relative to DAI, that's what we call a depegging event, right? Because now UST is worth 0.97 of a DAI. That makes a lot of people nervous. So what happened was people started seeing like, oh shit, this is suddenly worth not what I thought it was worth. Let me get the hell out of here. And everyone started running for the door and selling into UST. Now, in the case of UST, we have Do Kwon here to save the day. What Do Kwon did was he actually employed, I'm going to call him DK. What Do Kwon did was he had a reserve, a war chest basically, of a ton of cryptocurrency that he just kept in reserve exclusively to remedy an event like this. He had something like $4 billion worth of Bitcoin, a lot of assets. And basically what would happen is whenever there was a depegging event like this, he would create artificial demand for UST and bring it back to that 1-to-1 peg. So when this happened I think Saturday evening, Sunday morning, UST had a minor depegging event. It went down to 97 cents. Thing is, right, when you're dealing with like pools this large, you need a whole lot of capital to move the price even by a couple of cents. So Do Kwon sold like a few $100 million worth of his Bitcoin and used it to buy UST to maintain that peg. And that kind of settled people for a few hours. But what happened was either he didn't sell enough of it in time or people started selling in mass thanks to some other factors which I'll get into in a minute. and he had to sell all $4 billion worth of his war chest, and that still wasn't enough. So he couldn't artificially prop up the demand of UST, and all of a sudden everyone wanted to exit this pool. Suddenly this became, something like I think it came up to like 85%. So like of all the tokens in this pool, 85% of them were UST, and something like 15% were DAI. And when you're extremely imbalanced like that, the price falls significantly. So by Monday, the price of UST was down to like 60 cents, right? And that offers a really interesting arbitrage opportunity now. Because demand for UST got so low because people were spooked, what you could actually do is you could market buy UST, and sort of increasing the demand for it, immediately turn around and burn it for Luna. You'd get $1 worth of Luna. And at the time, Luna was actually at a pretty good price. It was something like $80-something. So like you'd get a decent amount of Luna and you would just immediately sell it, right? And you would make a healthy 40-cent profit for every UST you bought, which is kind of crazy. And the problem with that is it kind of creates a runaway effect, right? Because the demand for UST fell so much and there was just such a terrible imbalance in this exchange, you've got thousands and thousands of people pushing billions of dollars out of into UST and out of Luna effectively. So it started off very slow. The supply of Luna would increase by a few million each day from Sunday into Monday. But the problem is, as the price of Luna fell because more tokens were being printed, that meant even more had to be printed to maintain the arbitrage. And that's a feedback loop, which means more tokens get printed, Luna falls to $60, even more gets printed, Luna falls to $40, more get printed, falls to $1, falls to a fraction of a cent, everything dies. So yeah, that's kind of how the attack played out. Someone sold a bunch of UST and it triggered a cascading event. What's up?
So if there was no arbitrage, even though that bucket was a little messed up, things would still be okay.
So if there was no arbitrage in place, what would probably happen is people would just lose faith that UST is actually worth $1, and they would just all sell it, and like these numbers would change to 100%, right? And this would be 0%, and then this bucket completely freezes. Pretty much all you can do, like on an actual code level, is put in DAI for UST, and no one would want to do that. So this bucket, this exchange effectively dies. That like literally you would not be able to exchange because there's only one asset in this pool. You can't put in UST for more DAI because there's no DAI. Yes, you had a question?
So I guess you keep using the term attack. Is that the consensus that this was something that was almost certainly intentional? Obviously it's going to be speculation to some degree, but...
Yeah, it's up for debate. We call it an attack, but it's not really a malicious kind of attack. In a lot of these financial markets, everyone's kind of an independent agent, and we have to assume that everyone acts in their own self-interest. So someone out there saw a trade where they could depeg UST and somehow make money off of it. They actually made money by shorting Bitcoin because the whole crypto market crashed. And they took that opportunity. It just so happens that the collateral damage took down an entire blockchain. You had another question? Okay, cool. So yeah, what I'm trying to illustrate here is that even if UST somehow returned to peg, the problem is so much of it got sold, the market cap of UST shrunk so much as to completely destroy the value of Luna. And because Luna is used as kind of the native token of the blockchain, it becomes very hard to do any kind of transaction on it. You can't really pay for gas properly. You can't go on other exchanges and buy and sell it. Like I said before, everything just kind of becomes locked up. So the next thing I kind of want to explore is this thing called Anchor Protocol. And this is how UST became such a big behemoth in the first place. Anchor Protocol, I'm just going to make it an A, right? Anchor Protocol is a decentralized finance decentralized finance money market. It's kind of like a DeFi bank. What you can do with Anchor Protocol is you can take your UST and you can lend it to people, right? And they have to pay you an interest rate, right? Now, with the way interest rates work, you can only receive as much interest as the borrower is willing to pay you. So if you had $500, I wanted to borrow $500, you would give it to me, you charge something like 3 or 4% interest, right? And if I had that loan outstanding for an entire year, I would have to pay you, what would that be, $300 or $515 by the end of it. I'd pay you $15 in interest. Now let's say I wanted to borrow $800, right? You don't have $800, you only have $500. So maybe you and Arena pool your money together and you combined have $1,000. I'm gonna take out that $800 loan from your pooled funds and still pay that 3% interest rate. And what would that be? That would be 8 times 3. 24. Yeah, I need to work on my timetables.
Very good.
I'm not a math major.
This is more.
I also didn't pass. Well, actually, I did pass 4th grade math, but I never learned my times tables.
It's okay.
Anyways, so I would pay you $24 in interest, right? But combined, you both had $1,000 contributed into this pool. And we have no way of determining whose money I actually borrowed. I borrowed from both of you guys. So what ends up happening is that I take that $24 worth of interest and I split it evenly amongst you both, right? And since each of you guys contributed $500 to this pool, the real interest rate is actually lower than the 3% I paid to the pool because $200 was unallocated. It was just sitting idle. So in reality, of that $500 you lent out, you only got paid $12, which is like a 2.whatever% interest, like 2.8% interest. And that's how DeFi markets work, because there's almost never 100% utilization for a lot of these assets. So in the case of UST, there might be $40 billion worth of UST lent out, but at any given time there might only be like 10 or 20 billion being borrowed, right? And in order to maintain any kind of decent interest rate when there's that low a utilization, the borrowers have to pay an incredibly high interest rate. And no one's going to want to actually pay that interest rate when there's other stable coins that you could effectively do the same thing with at a lower interest rate. So like on some fundamental level, there's no real advantage to using UST in a money market as opposed to USDC or DAI. DAI and USDC are much, much bigger markets. They have much more depth. It's much easier to trade on them because of that, right? Your actions will have much less influence on the potential price of either of these assets. So here's what Anchor did. They saw that, hey, people don't actually want to borrow UST, but a whole lot of people want to try and deposit it. Do Kwon told me, hey, we want to pump the price of Luna or something to that effect. We want to grow the ecosystem. What we're going to do is we're going to take all these coins, that a chunk of that 56% of the initial supply of Luna, we're going to give it to you, Anchor Protocol. And what you can do is you can take those tokens, something like $150 million, there's a lot of money. You can take all that money and you can just give it to people, right? They gave it to people. And they gave it to them in the form of an artificially high interest rate. So, there would be 50 billion, right? 50 billion lent out on Lens Protocol at any given moment. And in reality, there's only 10% or 10 billion, 10 billion. There'd be only 10 billion borrowed at any given time. And in order to have their interest rate, their target interest rate, which was 20%, right, they would have to pay something insane like over 100% interest rate, all the borrowers. That's not sustainable. In reality, the borrowers probably only paid like between 5 to 10%. It was high, but it wasn't like absurdly high. And what Anchor did was they took that difference. So say let's split the difference and say it's a 6% interest rate, right? To split that difference, that 14% disparity, Anchor would take money out of that reserve that the Luna Foundation gave them and just turn it into UST and give it to the lenders, right? So that's how we ended up with this 20% interest rate. And let's pull up Aave real quick. I think I have a tab open. Do I not? So in a healthy money market, in a healthy DeFi bank, deposit interest rates are nowhere near that high. So let me actually change over to Arbitrum. That is not Arbitrum. This is Arbitrum. So in a healthy money market, right? If I were to deposit a stable coin, I would only get 0.35% APY, right? That doesn't sound very good, but that's just the natural way of things because not too many people in Aave, this DeFi bank, not too many people are borrowing USDC relative to the amount of people depositing it for collateral. So when people saw that, hey, I could put my savings, my stable coins, into this other DeFi bank and make way higher interest rates, that got a lot of people very, very interested, right? They wanted to put their savings into Anchor instead of Aave. And that's the primary thing that got UST to be so big, right? Because everyone wanted to deposit to get this artificially high interest rate. But there was only so much UST, so they had to buy Luna, burn UST, deposit into Aave, earn 20%. And it became this colossal game of financial chicken, became a Ponzi scheme. Because this yield reserve that Anchor received from the Terra Foundation wasn't going to last forever. They'd eventually run out of funds. Eventually, this interest rate would have to fall to something like 3%, or probably even lower, to be honest, given the utilization ratio. And when that happened, everyone would want to exit UST, and it would cause that death spiral I was describing earlier. It just so happened that because it's a game of financial chicken, everyone left slightly early before Anchor actually left. Because ideally, you don't want to leave when they're out of funds, because everyone's going to leave at the same time. You want to leave slightly before, so you get to take advantage of this high interest rate for as long as possible, without actually losing out on money because UST got depegged and the whole market collapsed. So yeah, thanks to this artificially high yield, Anchor became a colossal protocol. A lot of people used it, caused a kind of a Ponzi scheme. That's really what it is. I'm sure Anchor wasn't acting in bad faith. They weren't trying to deceive people, but it just kind of happened because there was no one in place to really step in and say, hey, this seems kind of sus, let's stop it, It's a tragedy of the commons type of situation, right? Everyone's acting in their self-interest. Anchor wants to get people to use their platform so they can advertise, hey, we got $50 billion worth of deposits. We're a reliable bank, guys. All the depositors want to earn that 20% yield. All the borrowers will do whatever they want to do. And the Luna Foundation is subsidizing all of this because when Anchor grows, the entire Luna ecosystem grows. And that's kind of the big issue here. When you look at UST relative to Luna is a lot more, it's a lot bigger than, say, DAI to Ethereum, right? Maker, the guys who create DAI, the stablecoin, if they were to go belly up today, it wouldn't cause that much of an issue because their entire market cap, like including their governance token, including the DAI stablecoin, is a couple $1 billion, whereas ETH is a few $100 billion. So the ETH price would fall, but it wouldn't destroy the blockchain because it's just one app on Ethereum out of hundreds. The problem is with UST, the algo stable, is that Do Kwon, the guy who made Luna, basically baked in this functionality on the chain level. There is no DApp that you go to burn Luna and get UST and vice versa. Meaning that if either one of these tokens fails, they both fail. Their fate is kind of tied. And that's a really big problem, of course, when you've got billions of dollars on the line and dozens of projects. So the aftermath of the issue, billions of dollars were lost. I mean, that's a given. It was, I think the number I threw out was $68 billion at the peak. Luna was worth a little over 50 billion. UST was, there were a little over 18 billion UST tokens in circulation. They're all gone. The VC firms that invested lost all their money. Everyone who invested at the top got very much wrecked. And even the people who were buying on the way down, trying to buy the dip, also lost out because there was this situation where the price of Luna would fall 99%, one day, fall another 99%, fall another 99%, right? So like someone who would buy here would lose 99% of their portfolio. They bought even more here, they would lose another 99% of their portfolio. That's just because of the hyperinflation of Luna itself. The demand fell and the token supply went from a few million to trillions. So in terms of like a recovery plan, Do Kwon is literally a fugitive. Like, I'm not even joking, he's being investigated by the SEC. The Korean Parliament is trying to get him to come in for an investigation. He actually dissolved the Luna Foundation right before the crash, which is very suspicious. The Luna Foundation was based in Korea. He's Korean. The Luna Foundation was dissolved like a week or so before the crash, and it actually moved to Singapore. So Do Kwon's somewhere in Singapore right now. I don't know if they have an extradition policy, the two nations. They might. I wouldn't know. The thing is, that war chest I was talking about earlier, that $4 billion worth of crypto that they used to try and maintain the peg, not all of it actually got sold. There's actually still 300 Bitcoins that are floating around, technically in the possession of the Luna Foundation, now based in Singapore. And there's a whole lot of people out there trying to get Do Kwon to use that to help recover Luna. The silver lining to this is that with the